So in the last class, we discussed the accounts receivable management. And today, let's discuss accounts payables management. If you think about accounts receivable and accounts payable, then you can see that they are very much related, right? So basically, if you have a firm, let's say this firm is a supplier. And then there is a buyer or customer, which buys something from this supplier. So basically, you can see that if the supplier sells something, right, to its customer, then the supplier will have accounts receivable, and then the customer will have accounts payable. So conceptually, these two things are very much related. So the first question we want to ask is, if you're the customer, if your supplier gives you a certain credit term, then whether should you take the discount or forego the discount? Recall the credit term we discussed in the last class. Let's say if you're the buyer, right, you have a credit term like this. Let's say it's 3, 10, net 30. So this basically means that if you pay your supplier within 10 days, then you will get a 3% discount. Or you could wait for 30 days and then you will pay back your supplier on day 30. Now, should you pay on day 10 or should you pay on day 30? Well, this is actually very easy. We discussed a problem very similar to this in the last class. So basically, we learned that this 3, 10, and 30 will imply a certain interest rate, right? Because it basically means that on day 10, you can pay 97, or on day 30, you can pay 100. So basically, you can see that over the period of 20 days, right, you will have a interest rate of 100 divided by 97 minus 1, right? So now the decision on whether to forego this discount really is about whether this trade credit is the least expensive source of funding or not. Let's say if this interest rate equals, let's say it's 4%, right? That is, over 20 days, the interest rate is 4%. Now, if you can obtain some financing from bank, which has an interest rate of 3% over 20-day period, then in this case, you should definitely obtain the loan from the bank and use the loan to pay your supplier to take advantage of the 3% discount. And then at the end of the day 30, you will pay back your bank, right? Of course, if this 4% rate is the best you can get, then you will wait and pay your supplier on day 30. And then there are some factors which will affect this interest rate, right? The first is the discount. The higher the discount percentage, then the larger the cost of foregoing the discount. This is easy to understand, right? Because if the discount is 3%, then by foregoing this discount, you're essentially paying a 4% interest rate. Now let's say the discount is 10%. Now in this case, you can see that the implied interest rate over the 20-day period would be about 11%. So this pretty much says that by foregoing this discount, you're essentially paying this 11% interest rate. So this tells you that if discount is 3%, the cost of foregoing this discount is 4%, and if the discount is 10%, then foregoing the discount will have an interest rate cost of 11%. So this tells you higher the discount rate, larger the cost of foregoing the discount. And then the second factor which affects this interest rate cost is the loan period. If the loan period is shorter, then the cost of foregoing this discount will be larger. Well, this is easy to understand, right? So let's compare two different credit policies. Let's say the first is 310 net 30, and then the second one is 310 net 60. So in this case, you can see that your interest rate is 100 divided by 97 minus 1 over 20 days. And then in the second case, it's 100 divided by 97 minus 1 over 60 days. So you can see that in this case, you're paying 4% interest rate over 60 days. But in this case, you're paying 4% interest rate over 20 days. Oh, sorry. In the second case, I should not use 60 days. I should use 50 days because 50 equals 60 minus 10, right? So in the first case, right, you're paying 4% over 20 days. In the second case, you're paying 4% over 50 days. So clearly, the cost of foregoing the discount is larger in the first case with a shorter loan period, because in the first case, the loan period is only 20 days, and in the second case, you have 50 days, right? So this basically means if you're a firm, if you're thinking about whether to take the discount to pay your supplier, you have to think about the discount percentage and the length of the loan period. And then the second important point of optimally managing your accounts payable is, as a firm, you should pay as late as possible, no matter you take the discount or not. So again, if it's 3, 10, 30, then if you want to take the discount, you should pay your supplier on day 10. And if you don't want to take the discount, then you will want to pay your supplier on day 30, right? This is very easy to understand. Let's say if you don't want to take the discount, then you should not pay your supplier on day 25, because this is a bad idea, because you can wait for 5 days. Why do you want to wait for 5 days? Because waiting for 5 days essentially is equivalent to the case that you're getting a loan for 5 days without any interest rate, right? So you definitely want to wait for additional 5 days and to pay your supplier as late as possible on day 30. Okay. Of course, we said, well, you want to pay as late as possible, but you don't want to be too late, right? You definitely want to make sure you're paying back your suppliers on time. So how do you do this? Well, it's pretty easy, right? You will basically look at your accounts payable days, and then you will look at your credit terms offered by your suppliers. So let's say if you have a credit term which is 210 net 30. Let's say you don't want to take the discount, which means you should pay your supplier on day 30. And then you will calculate your accounts payable days, and you find out it's only it is 40 days. So this basically means that you're paying your suppliers 10 days late, right? And if your accounts payable days is just 25 days, then it means you're paying your suppliers 5 days earlier, right? So you will adjust accordingly. Okay, let's see this. So the road company has an average accounts payable average accounts payable balance of $250,000. Its average daily cost of goods sold is $15,000, and it receives terms of $215 net 40 from its suppliers. So Road chooses to forego the discount. Is the firm managing its accounts payable well? Well, it's pretty easy, right? As I said, you will want to calculate accounts receivable days, which is, according to this basic accounting formula, we should use accounts receivable as the numerator, and we will use the daily COGS as the denominator. Now we plug in numbers. So we have 25000 and divided by 1400, which will give us a number of 17.9 days. So you can see that according to the credit term, if the firm does not want to take the discount, then the firm should pay its supplier on day 40. However, its accounts receivable days is almost just 18 days, right? So this basically means that the firm is paying its suppliers too early. And you can see that the firm pretty much has two choices. It could delay this payment to day 40, or it could move the day, or it could pay its suppliers 3 days earlier. Then the firm will be able to take advantage of this 2% discount. Okay. Of course, sometimes firms will have their accounts receivable days larger than the days indicated by their credit terms. In this case, the firm is stretching its accounts payable. So basically, this means a firm ignores a payment due period and pays later. So for example, if the suppliers give the firm net 30, in this case, the firm actually pays on day 45, then clearly this firm is stretching its accounts payable. Of course, this could be bad. This could have consequences, right? Suppliers could actually impose some late fees or modify this terms. For example, the suppliers could require cash on delivery, right? Or cash before delivery. Then in this case, the customer firm won't be able to stretch its accounts payable anymore. Okay, let's see this simple example. What is the effective annual cost of credit terms of 115 net 40 if the firm stretches the accounts payable to 60 days? So first, why the firm wants to stretch the accounts payable? Well, because you will see that the firm will actually have lower interest rate. Okay, so let's say it's 115 net 40. If the firm decides to stretch the accounts payable to 60 days, then the discount on day 15 would be 99, and then the payment on day 60 would be 100. And then the number of days between these two payments would be 45 days. So you can see that the annualized cost or annualized interest rate would be 100 divided by 99, and we have 365 days per year, and then we have this 45-day period. So this gives us 8.49%. And you can also check that if the firm decides to pay back its supplier on day 40, then the interest rate will be higher, right? Because if the firm decides to pay back its supplier on day 40, then we will use 365 divided by 40 minus 15, which is 25. So we will definitely get a higher interest rate than 8.49%. Okay, now we move on to inventory. Obviously, inventory is an important part of current asset, which is an important part of working capital. So now we will discuss the costs and benefits from inventory. Clearly, as the firm's financial manager, you will want to think about this question. So first, why do you want to think about this? Well, because if you have a lot of inventory, then you will tie your cash in inventory. This means the firm's free cash flow will be smaller. So if you can better manage your inventory, then you will be able to increase your firm's value. Now, what are the benefits of inventory? It's pretty easy to understand. So we will go through this section pretty quickly. First, this could prevent out of stock events, right? So basically, if you have enough inventories, then there will be no risk of the out of stock situation. Then you will not lose sales because of out of stock problems. Then the second is meet seasonality in demand. So basically, let's say if you're in retail, then most likely you will see a huge demand in winter, right? Because of New Year, because of the Thanksgiving days, because of the Christmas days, right? So because of these holidays, you will want to increase your inventory, maybe in September or October, to meet this seasonality in demand. Now, there are obviously some costs if you have a lot of inventory. So we will talk about 3 costs of holding inventory. The first is acquisition cost. It basically means that to acquire the inventory, you have to pay some money. So acquisition costs are essentially the costs of the inventory itself. And then there will be order costs. So these are costs incurred to create and process your order. So basically, you can imagine that if you want to order your raw materials or inventory, then you have to call your supplier, you have to spend time and money, right? And then the third type of cost would be the carrying costs. So this basically means that if you hold inventory, then you will pay storage costs, insurance costs, taxes, and some other costs, right? Or the opportunity cost of your funds tied up in the inventory. This basically means that if you spend money in your inventory and you hold your inventory somewhere, then your funds, your money is tied in your inventory. So you cannot use your money anymore. Now, so as a financial manager, you definitely have the incentive to reduce inventory costs, right? So what kind of methods we can use to reduce inventory costs. First, you have to think about the trade-off. You have to think about first the benefits and the costs trade-off. And you also have to think about the trade-off between different inventory costs, right? So if you look at the costs we just mentioned here, you can see that order cost and carrying costs, they're negatively correlated. It basically means that if you want to reduce your carrying costs, then you will you will hold smaller inventories. This might imply that you have to order more frequently. So this will increase your order cost. Or you could hold large inventory. In this case, you will pay a larger carrying costs and you will order less frequently. So in this case, you will have a smaller order cost, right? And then the second method is to use the just-in-time inventory management. It's sort of like this real-time inventory management system. It basically means that you only acquire your inventory when you need that inventory to make your product, right? So clearly this one is actually hard because it's almost real time and you have to forecast your demand. So for example, you have to forecast your demand in December because you need to order in November. And your forecast better be good because if your forecast is way off compared to actual demand in December, then your inventory in November will also be way off. So clearly this will create some additional costs. Okay, great. So now we talk about the cash management. Again, cash is an important part of current assets. So to think about working capital management, we will definitely talk about cash management. Again, this section is quite simple, so we will just go through these pages pretty quickly. Now, why a firm wants to hold cash? Well, because if you think about it, cash is generally considered a bad investment, right? Because cash does not generate any returns. So there are at least three motivations for a firm to hold cash. The first is the firm needs some transaction balance. This is easy to understand. It basically means the firm needs to pay its bills, right? Let's say it's utilities, it's office rentals. So the firm needs the transaction balance. And then the second type is, or the second motivation is, the firm needs some precautionary balance. This is easy to understand. It basically means that a firm faces uncertainty in its business operations. So possibly in the future, the firm will need some additional cash if some uncertain events happens. So the firm will hold some cash to counter this uncertainty. This is called precautionary balance. And then the third motivation is the firm will hold some compensating balance. This is more related to a firm's financing needs. So basically, compensating balance refers to the balance held by a bank. And why the bank needs this compensating balance? Well, because the firm is obtaining some loan or some line of credit from the bank. So the bank needs this compensating balance as a compensation for services the bank provides to the firm. Okay. So to smartly, to optimally manage a firm's cash, normally a firm can invest its cash in some very liquid short-term securities, because this basically can enhance the firm's returns on cash, right? Even generally, the return will be very low. Clearly, in this case, the financial manager will want to think about return versus risk and investment horizons. And here you have some money market investment options. Generally, a financial manager, if this financial manager wants to invest the firm's cash, then the manager will invest in money market in money market options, and you can see that we have these cash management bills, T-bills, and CDs, repurchase agreements, and bankers' acceptance, and commercial paper. So if you have time, of course, you can look at this table, but this one is completely optional, so it will not appear in your exam or homework. Okay, so this is a pretty easy chapter, right? Because I would say it's more related to accounting. So we just basically used some very basic accounting equation to understand the working capital management, right? Okay, now let's review this chapter. So first, what is the difference between a firm's cash cycle and operating cycle? First, what is operating cycle? Well, it's the time, right, between two events. That is when the firm purchases its inventory or raw materials, and when the firm gets money from selling its product, right? The accounting formula for operating cycle is operating cycle, right, equals inventory days. Okay, I'll just use IVD to refer to inventory days. So operating cycle equals inventory days plus accounts receivable days, right? And then when we talk about cash cycle, it's a cycle about cash, right? About money. So basically, cash cycle refers to the time period between two events. The first event is the firm pays its supplier, and the second event is the firm gets cash from its customer. So you can see that So you can see that cash cycle equals operating cycle minus accounts payable days, right? Or you could say cash cycle equals inventory days plus accounts receivable days minus accounts payable days. Now, how does reducing working capital impact a firm's value? So generally, you want to reduce working capital in a proper way, because whenever you increase your working capital, you will tie up your cash. Whenever you reduce your working capital, you will free up your cash. So reducing working capital basically means you will have higher free cash flow. So this will enhance your firm's value. Why do firms provide trade credit? We discussed this in the last class. So basically, we know that firms are not banks. However, they will provide trade credit to their customers. There are basically two reasons. The first reason is generally firms understand their customers, right? So they understand how credit worthy their customers are. And the second is firms they understand the trade credit is a type of debt with low credit risk. The reason is first, the trade credit can be considered as a secured loan, because if there is default, then basically the firm can secure its customers' inventory, right? So this has very low credit risk. Okay, fourth, what is the difference between accounts receivable days and the aging schedule? This one is quite basic. So aging schedule is basically a table, And in that table, you will list different customers' accounts receivable days. And then you will look at what percentage of customers they're late, right? Okay, fifth, what are the benefits and the costs of holding inventory? Oh, we just talked about this. What are the benefits? First, you don't want to get into this problem of out of stock, right? Because that means you will lose sales. And if you have higher inventory, then you will generally be able to meet your customers' demand. And a second benefit is you could you could deal with seasonalities in demand more properly if you have higher inventory, because if a holiday season comes, then you would know that there will be a higher demand, so you will have to increase your inventory. Costs, there are three different kinds of costs. The first is acquisition cost. You have to pay your inventory. And there is order costs. You have to spend time and money to order your inventory. And there is carry cost. That is, you have to store your inventory in a secure location. So in this case, you will have to pay storage costs, insurance costs, and some other costs. What kind of trade-off does a firm face when choosing how to invest its cash? Generally, we say that a firm will want to maintain some cash. However, to enhance the return on the firm's cash, the firm can invest its cash in low-risk liquid securities. And I mean, this is same as all investments. You will always think about the trade-off between return and risk, right? So this is really easy question. Okay, great. So now let's move on to the next chapter, which is chapter 27, short-term financial planning. Okay, so you can see that we discussed long-term financing, right? Such as equity financing and debt financing. And we also talk about lease versus buy. And leasing can be considered as a special case of long-term financing. So in this chapter, we will focus on short-term financing. So if you think about short-term financing, then you can see that first you will have to think about your financing needs, right? So you will forecast your short-term financing needs, and then you will obtain that short-term financing. And then we will talk about the matching principle, which tells you will do this horizon matching between your financing needs and your financing. And then we will talk about different forms. So then we will talk about different forms or sources of short-term financing, right? So bank loans, commercial paper, and secured financing. Okay, now let's talk about the first topic, which is forecasting short-term financing needs. You can see that this is clearly important because we're talking about financial planning. The key word here is planning. So if you want to plan something, then you have to anticipate something. So if you want to plan your financing, you have to anticipate and forecast your financing needs. So after forecasting your short-term financing needs, then you will think about whether these financing needs are really short-term or long-term, right? Let's say you find out you have some surplus of cash. Then if this surplus of cash is permanent, then what you will do with this permanent surplus? Well, you will think about payout, right? Maybe you will increase your dividend payout, or maybe you will do some stock repurchase. Let's say if you have some permanent deficit, then in this case you will possibly do some external financing, right? Maybe you will issue some equity. Now, the second case, you find out your surplus of cash or your deficit, they're actually short term, they're actually temporary. Well, that's what we want to discuss in this chapter. Okay, we will discuss this using a example. Springfield Snowboards. So let's say this firm produces snowboarding equipment, and this firm sells the snowboarding equipment to retailers. So the firm anticipates that in 2019, its sales will increase by 20% to $20 million, and its total net income would be this almost $2 million. Now we assume sales and production will occur uniformly in 2019, and you will see what does this mean, this uniformly mean. Okay, now let's see this firm's income statement and statement of cash flows. So what you can see here is the firm's sales in Q4 increases from 4,545 to 5,000, right? So, because we know that there is a 10% increase in its sales in 2019. And then we know that the sales will occur uniformly throughout 2019. So this basically means that the sales number will be distributed evenly across 4 different quarters, right? Now our focus is on the firm's cash flows. So we want to look at the firm's cash flows. Now let's see, if you look at these 4 numbers, right, you will first see that the firm's cash flows, they're actually quite stable. Q1 has a cash flow of 399, and Q2 to Q4, the firm has a cash flow of 488, right? Now, if you look at the income statement, you can see that, well, it's really because the firm's sales numbers, right, they're evenly distributed, and then we have the same COGS in different quarters, the same SG&A in different quarters, and this will give us the same net income in different quarters. And then we will adjust it from net income to get our cash flows. So you can see that we have this constant depreciation. Then the only variation here is the working capital, and you can see that the variation is not very large. So that's why you will see some variation in the cash flow in Q1 2019. So you can see that in this case, it's a simple case because you have a smooth cash flow, right? So in this case, you can see that the cash flow is pretty smooth, and you will have excess cash flow in each quarter. So in this case, it's quite possible these excess cash flows will be permanent, right? So basically you can see that if in the future the firm will have similar sales, the firm will have similar working capital, similar capex in the future, then the firm will have similar cash flows in the future. So the positive cash flows will be permanent. Then in this case, these excess cash flows could be paid out by the firm. Now the firm can do 2 things: either increase the dividend to its shareholders, or the firm can use the increased cash flows and accumulate these excess cash flows to do a share repurchase. Okay, now let's think about more complicated cases. So there are several cases we want to consider here. The first one is we will think about seasonality, and we will talk about negative cash flow shocks, and we will talk about positive cash flow shocks. So basically, these three different cases will require some additional short-term financing. Okay, now let's look at seasonality. So if you look at our model assumptions, we assumed this firm's sales occurred evenly across the year, and you can see that this is not true because this firm produces snowboarding equipment. So you can see that there should be seasonality in this firm's sales, right? So basically, you can imagine that in summer, the firm's sales should be lower, and in winter, the firm's sales should be higher, right? So now let's consider this more realistic case. So now we assume 20% of the sales occurred in the first quarter, and then 10% would occur in the second and third quarters, and then 60% will occur in the fourth quarter, right? So now if you compared with the previous table, you can see that the huge difference here is the sales number will have this seasonality. That is, the highest sales number would occur in Q4 2019, and the number would be 12,000. And then Q1 would have 4,000, and Q2 and Q3, they are pretty low, about 2,000. Accordingly, we will have different COGS, right? And then we assume SG&A, they're roughly the same, because you can see that SG&A, so SG&A really acts like a fixed cost, right? I mean, no matter how large your sales number is, you will still pay the similar amount of sales general and administrative costs, right? So this will create large variations in the firm's net income. So in Q4, net income is close to 2,000. And then in Q2 and Q3, we get some number close to minus 100. And then this net income, this large variation in net income will translate into the large variation in the firm's cash flows. And you can also see that the change in working capital will magnify the firm's variation in cash flows. So basically, you can see that there will be an increase in accounts receivable in Q1. There will be a decrease in accounts receivable in Q1. There will be an increase in inventory in Q1, Q2, Q3. Well, these numbers are quite easy to understand. So if you look at this number, well, it basically means that in Q4, the firm will have a lot of sales. So it will create accounts receivable. And then in Q1, the firm will receive money from its customers. So accounts receivable will be lower, will be smaller. In this case, you can see that we get a positive number here. So this will increase the firm's cash flow. Then it's also easy to see that we will have a negative number here because, well, in this case, the firm will have a lot of sales in Q4. So this will create accounts receivable. So this will reduce the firm's cash flow. Okay, and if we look at the inventory, it's also easy to understand, right? We have, so the firm is building up its inventory in Q1, Q2, Q3 because the firm will have a very large sales number in Q4. So the firm needs to build up inventory for Q4. And then in Q4, the firm will use up its inventory. So its inventory will reduce. And this will increase the firm's cash flow in Q4. And in the end, you will see that in Q1, the firm has a large cash flow of 1763. And then in Q2 and Q3, it will have very negative cash flows, right? So 1448 and negative 2048. And in Q4 of 2019, the cash flow is a large positive number, right? So 3,400. Clearly, you can see that the firm will have to obtain short-term financing because for Q2 and Q3, the firm will have negative cash flows. So basically, you can see that what the firm will do is it will basically obtain short-term loan, right, for these 2 months. And then the firm will be able to repay its short-term loan with the using the cash flow from Q4, right? So the cash flow in Q4 will be able to pay back these short-term loans obtained in Q2 and Q3. Okay. So the gist here is seasonality will create needs for short-term financing. Now let's look at negative cash flow shocks. And if you look at the word negative, you will know that the firm will definitely need some cash flow, right? Sorry. This firm will definitely need some financing because it's a negative cash flow shocks, which means firms' cash flows will be negatively affected by the shock. So let's see what kind of shock do we have here. Now let's say we maintain our initial assumption, that is, the firm's sales and production will occur evenly across 2019. However, we assumed in April 2019, this is a typo, we should have 2019 here. So we assume in April 2019, the firm finds out its equipment needs replacement. So the firm needs to spend $1 million to replace the broken equipment. So this is a negative cash flow shock, right? Because there is this $1 million capital expenditure. And we know that CapEx will reduce a firm's cash flow. So now let's see how the firm's cash flow will look like. And you can see that here we have these net income. And you can see that net income, they are roughly the same as the first table, right? As this table. Right? They're roughly the same. But you can see that there are some minor differences. So the net income in Q3 and Q4 will be slightly different. The difference is because of the depreciation here. Why do we have these different depreciation numbers? Well, that's because we have made capital expenditures in Q2. So this will definitely affect the firm's depreciation in Q3 and Q4. Now, the most important thing we want to look at is this guy here, right? So this is a one-time negative cash flow shock. This sudden increase in the firm's capex. And this will reduce the firm's cash flow. And you can see that now we have a negative number, right? Again, this tells you that in this case, there is the need for the firm to obtain short-term financing. So the firm, again, after obtaining the short-term financing, the firm can use its future positive cash flow to pay back its loan. Now, let's think about the third case, positive cash flow shocks. So let's assume now there's some positive cash flow shocks. Judging by the name, you might think this is a weird case, right? Because if you have positive cash flow shocks, then you will have some additional cash flow, right? So why would you need additional financing? Well, in this case, if you look at this case, you will see that, well, yeah, in the future, right, you will have some positive cash flows. However, in anticipating that future positive cash flows, you will incur some negative cash flows today. So let's see the case. So let's say we assume during the first quarter of 2019, the firm says it has a deal and it will become the exclusive supplier to a new major customer. So the firm forecasts the sales will increase 20% in the future. And the sale increase will only begin in Q2. Now, because the firm will have a larger sale in the future, so maybe the firm will want to spend some extra money for marketing, right? So let's say we assume the firm will spend a one-time expense of $500,000 for marketing and an extra $1 million in capex, because to meet higher demand in Q2, the firm needs to increase its production capacity. Okay, now let's see how the firm's cash flows will be affected. So what you can see here is the firm's future net incomes will be higher because the firm will make larger sales in the future. However, the Q1's net income will be lower because there is a higher SG&A, because we said the firm will have to spend additional $500,000 to do this marketing campaign, right? So Q1 2019's net income will be lower. And then we will see that the capex will also be higher in Q1. So both of these two expenses, that is larger capex and larger marketing cost, will push down the firm's cash flow in Q1. So what you're seeing here is that the cash flow in Q1 2019 is actually quite negative, right? It's almost minus $1,000. And you can see that even in the future, the firm will have higher cash flows because of the increased sales. Then to get this, or to satisfy this increased demand in the future, the firm has to incur the first period negative cash flow. And then you can see that this is another case that the firm needs short-term financing, even the firm has this positive cash flow shock, right? Okay, now let's talk about the matching principle. So if you think about financing, financing is actually an expensive process. There are a lot of transaction costs, right? So think about this. Let's say you're a firm. You're thinking about using long-term debt versus short-term debt. Now, if you use a lot of long-term debt, then it's possible you will raise too much money from long-term debt. In this case, you will have some excess cash. And we know that cash is expensive because cash does not pay you interest, right? So this is a type of transaction cost in debt financing. Now let's say on the opposite, you will think about using a lot of short-term debt. Now in this case, you can imagine that if you use a lot of short-term debt, then the firm will have to refinance its debt on a consistent basis. So this basically means the firm will have to negotiate new debt again and again. So basically, this will again incur high transaction costs. Now, how firm can minimize these kinds of costs? So essentially, how a firm should choose the optimal amount of long-term financing versus short-term financing. Well, we will use the matching principle. It's actually a very intuitive and very simple, very easy to understand financing principle. So matching principle says your short-term needs should be met with short-term financing. Your long-term needs should be met with long-term financing. It's very intuitive, right? So to understand this better, we will decompose working capital into two components. So basically, if we think about working capital, now we will think that working capital equals permanent working capital plus temporary working capital. So now let's define what is a permanent working capital, what is a temporary working capital. So permanent working capital refers to the amount that the firm must have in its short-term asset to support its continuing operations. So basically, you can see that because this part of current asset or this part of permanent working capital is permanent. So definitely you should finance permanent working capital with long-term financing, such as long-term debt, right? And then temporary working capital is essentially the difference between your working capital and your permanent working capital. So essentially these are temporary short-term assets you need to support your operations. And then because it's called temporary working capital, then you can imagine that to finance the temporary working capital, you will want to use short-term financing, such as short-term debt. So now let's again look at this Springfield snowboarding example. So in this example, you will see that the difference between permanent and temporary working capital. So what you can see here is, so again, we're dealing with this case that the firm has its sales evenly distributed across different quarters. And if you look at the firm's net working capital, you can see that the Q3 requires the highest level of working capital at 5,420. And Q1 has the lowest working capital requirement. So you would only need 2,125, right? So in these numbers, you will find out a number which tells you what is the firm's permanent working capital. So we will consider that the Q1's number, right? We will consider this 2,125 as permanent working capital. Why? Well, because this is the minimum level of working capital, right? Because across all quarters, the firm has to at least have this amount, 2,125. That is, permanently, the firm will have to maintain this level of working capital. So we consider this amount of net working capital as our permanent working capital. And then you can see that if this is our working capital, then the difference between this minimum level and the higher level in other quarters will be our temporary working capital, right? For example, if we consider, for example, this is our permanent working capital. And in Q2, how do you calculate temporary working capital? Well, it equals the total net working capital, 3,475, minus the permanent working capital, which is 3,475 minus 2,125. So it would be 1,350, right? Okay. Oh, by the way, if you use matching principle here, then this basically means to finance this amount, you will use long-term financing. And for finance this amount, you will use short-term financing. Okay, now let's talk about some alternative financing choices. Because we said, well, we could use matching principle. It's intuitive and it's simple. What about some other variations? So we could talk about two kinds of variations. The first is aggressive financing. The second, well, you guessed it, conservative financing. So aggressive financing refers to the case that you would finance part or all of your permanent working capital with short-term debt. You can see that this is called aggressive because with the matching principle, you should finance permanent working capital with long-term debt. And now you become more aggressive in your financing, so you will just use short-term debt. Clearly, this will have benefits and costs. So what are the benefits? The first one is short-term debts, they're generally cheaper because we know that if a debt has a longer maturity, then its yield will generally be larger. So it will be more expensive. And then short-term debt could also reduce agency costs. So this is the argument we have made in corporate finance too. So generally, if the firm uses long-term debt, the firm could have some excess cash, and then the pressure to repay the debt will be smaller compared with short-term debt. So manager could do some bad things, right? And then there are also some costs. There are some additional risks. The first is interest rate. The first is interest rate risk. This is easy to understand. So basically, if you have a long-term debt, let's say if you're a firm, you have obtained a 10-year debt at a yield of 3%, then this basically means you have locked in this 3% yield for the next 10 years. But if you use short-term financing, let's say you will just use a 1-year debt, then this means that after 1 year, you're really not certain what kind of yield you can get, right? So basically, you will face this uncertainty that your interest rate will be different when you refinance your debt. And then there will also be some funding risk, because if you have to constantly refinance your debt, then potentially you could run into the problem of not being able to refinance your debt in a timely manner or at a reasonable rate. So in this case, your firm will have to suffer from financial distress costs. Okay, conservative financing policy. So conservative financing policy basically means that you will use long-term debt for both your permanent working capital needs and temporary working capital needs. So you can see that this is conservative, and the benefit is that the funding risk will be so the benefit is the funding risk will be smaller, and the cost is the firm will have excess cash, right? Because if you have long-term debt, then depending on your firm's needs, right? In some time during some quarters, you will have some excess cash, right? In this case, again, the same argument. Excess cash is not good because it does not earn you interest rate, or it only earns you very low interest rate. And excess cash will also make agency costs more severe, because we know that according to the free cash flow hypothesis, manager may have this empire building preference. So if the manager has too much cash in their pocket, then they could engage in this wasteful investment. So this will definitely destroy shareholders' value. Okay, now let's talk about different forms of short-term financing. So the first one is short-term financing with bank loans. Bank loans are a very important source for short-term financing. And this is especially true for small businesses, because you can think that the major forms of financing for a business is basically bank loans, corporate bond, and equity financing. And if you're a small business, then generally the only source will be bank loans. So here we will talk about three kinds of bank loans. First, single end of period payment loans and lines of credit. Third, bridge loans. So if it's a single end of period payment loan, then basically the firm will pay interest payment on the loan, and it will pay back the principal at the end of the loan. And the interest rate charged on this type of loan can be fixed or variable. If it's variable, then generally it's a benchmark rate plus some spread. So generally the rate will be some spread relative to a benchmark. So let's say if benchmark is 2%, if you have good credit, maybe your bank will charge you 2% plus 1%. So in this case, this 1% is the spread here. But let's say this firm has bad credit, right? In this case, maybe to offset the default risk, the bank will charge 2% plus 3%. Right? So for a less credit-worthy firm, the interest rate will be higher. In this case, 3% is the spread here. So generally, there are two kinds of benchmark rates. The first is the prime rate, which is the rate the banks charge their most credit-worthy customers. And then the second one is LIBOR. It's the London Interbank Offered Rate. So it's the interest rate at which banks borrow money from each other in the London interbank market. And then the second type is the line of credit. So line of credit is a bank loan with a preset credit limit that can be used at any time. So it's sort of like firm's credit card, right? There are two kinds of line of credit here, depending on the bank's commitment. So the first type is uncommitted line of credit. So in this kind of line of credit, the bank is not legally binding to provide the funds to the firm. Committed line of credit. In this case, the bank is legally binding to provide funds to the firm as long as the firm satisfies the restrictions in the loan agreement. Banks, they generally renegotiate the terms of a line of credit on an annual basis, but there are some special cases. The first is the revolving line of credit. So in this case, the line of credit will last for a longer period of time, typically 2 or 3 years. And then there's evergreen credit. So in this case, it's a revolving line of credit without maturity. Okay, the third type, bridge loan. Judging from the name, you can see that this loan is a type of short-term debt that is used to bridge the gap, right? So that's why it is called bridge loan. So what gap do we want to bridge here? Well, sometimes the firm will have some gap in its financing. So bridge loan is the loan the firm wants to use before the firm obtains its longer term financing. Okay, so you can see that we have gone through these 3 types of bank loans, and I would say this it's just like common sense, right? So it's pretty simple here.